Right, welcome to part one of lecture 9-B, but before we actually kick off with the lecture, we're going to look at going to review the three methods of determining allowance for doubtful accounts, which was covered off in the previous lecture. So, if you recall, first method was percent of sales, right, or credit sales. And this takes a flat rate of the credit, or a percentage of the credit sales, and that's used to determine the bad debt expense. 2 is the percent of receivables. And this, similar to percent of sales, takes a percentage of the receivables, and that gives you what the allowance for doubtful accounts should be, and then you have to do a journal entry to get it to that number. And then finally, a variant of that percent of receivables is the aged receivables method, which uses different percentages for different categories of the receivables depending on how old they are. So the older the receivable is, the more likely it is to not be collected. And so that sort of weighted average, I guess, of those receivables is what's used to come up with the correct amount to be in the allowance for doubtful accounts account balance. And then you have to do a journal entry to get it to that correct amount. Okay, so today's lecture is going to discuss notes receivable, and we're also going to look at a couple of financial ratios. Before we launch completely into notes receivable, though, there's one final piece that I wanted to touch on, and that was, we looked at sales and receivables. How do things work with credit card sales? What potentially changes? And the most common credit cards are what the textbook calls bank credit cards, Visa, MasterCard, and so on. And the entry there is simply debit to cash because, well, I'll explain why in a second, for, say, 98. A debit to credit card discount expense for 2. And then, a debit to credit card. Yeah, debit to credit, I know. And then credit to sales revenue for 100. And the reason why you would record a debit to cash is that with electronic business now, businesses get paid within a day or so, end of the day, possibly even instantaneously from Visa, MasterCard. So they get paid right away, but it costs them this 2% of sales figure, right? So this is an expense, credit card discount expense, EXP. Didn't leave myself enough room here. Now, if you have what the book calls a non-bank credit card, and these are becoming less and less common, things like a diners club or something like that, where the business actually has to gather up their slips and mail them in or somehow transmit those slips in. Instead of recording a debit to cash, you would record a debit to accounts receivable. And that's just how that would play out. If you're using a debit card, same sort of thing. You have a debit to cash, and I think the book uses a title debit card service fee or transaction fee, something like that. And then sales, and that would be like 98 to 100. Although usually debit cards are cheaper than credit cards. So you just need to understand that you're going to have this little expense being kind of gathered up or accumulated as a result of accepting credit and debit cards from your customers. And often the debit card is a flat fee, 10 cents, 15, 25, 50 cents a transaction, whereas the credit card is a percentage of the dollar amount. So that's how the journal entry works for credit cards. Now, let's do a quick little demo problem to do with credit card sales here, looking at gas stations. We have a number of different types of payment that were accepted. So we have Visa, i.e. a bank credit card, non-bank credit cards, and debit card sales. We have the figures for what they charge, and we're asked to record these sales transactions for the Petro-Canada station. Okay, so the Visa transaction is going to be, as we said, a debit to cash. And so that'll be the $20,000 times, 1 minus 2%, 98%. And that will give 19,600. Then we have that credit card discount expense 2%, right? $400, 2% of 20,000, and then a credit to sales revenue of $20,000. So that's the Visa. Then we have the non-bank, and that was $5,000. So here, remember that we're dealing with accounts receivable, not cash, and then it's again going to be credit card discount expense, and then sales. Sales was $5,000, 3.5%. Pardon me. So credit card discount expense 3.5%. I should have put percent in there. There we go, 3.5%. So 3.5% of $5,000 is $175, which leaves us $4,825 going to accounts receivable. And then the last one, I guess we'll do on the next page, is the 1.5%. So here it's percent, not flat rate, but 1.5% of the 16,000 debit card sales. Okay, so again, debit to cash, debit to debit card service fee, 1.5%, and credit to sales. Now it was $16,000 worth of sales. 1.5% of 16,000 is 240, which means then that the debit to cash is going to be 15,760. Okay. So now let's look at notes receivable. And the whole idea here is that with accounts receivable, you have basically a verbal loan agreement between the seller of the good. So the seller is lending the buyer some money for 10, 30, whatever, how many days to buy their products, and they're going to be paid. And it's a verbal sort of, handshake deal. But if the dollar values get bigger, or if it's just not to do with trade, but just someone wants to lend somebody else some money, for example, the bank lending you some money for a car loan, instead of a verbal deal, they will formalize it and sign a document. That document is called a promissory note. It's a promise to pay. I mean, it's also known as a loan agreement, if you want to call it that. But at the end of the day, that is, from the lender standpoint, that document becomes, and the amount that is to be paid becomes a note receivable. And from the borrower's standpoint, it becomes a note payable. So, bunch of terminology for you to kind of get familiar with. Some of it's fairly straightforward. Debtor, creditor, maker, payee, whatever, principal, interest period, interest rate, maturity date, maturity value, and so on. But the key thing that, for practical purposes, distinguishes notes receivable from accounts receivable is there is usually interest associated with a note receivable. Now, it can be interest that's paid on a monthly basis during the life of the loan, but typically the most common is simply the interest is paid at the maturity date. So when the loan is repaid in full, it's repaid in full plus all the interest at that point in time. Now, because we have this, it adds a little wrinkle, this interest, it adds a little wrinkle in our accounting in that we have to account for this interest. Okay, so let's take a look at Brenda and her situation. So on January 1st, she lends $10,000, 5% for 1 year. She would record the following entry. Debit to note receivable, $10,000. Credit cash. Okay. And so a year later, Brenda gets paid, so she gets repaid in cash, and the note receivable goes away. But Brenda also records interest revenue. So she gets her $10,000 plus $500 interest, so $10,500. the note disappears by crediting note receivable for $10,000, and the interest revenue is that $500. So this was after a year, right? The loan on January 1st, and then repayment on December 31st. Let's say, though, that Brenda, instead of a December 31st year end, let's say that Brenda has now a March 31st year end. What happens when we get to year end? Well, she's lent the money for January, February, March, 3 months. She's earned interest on it in that period of time, right? So she does need to make an entry to record that interest revenue. And so what does that look like? Well, on the 31st of March, she's going to record a debit to interest receivable because she hasn't been paid yet. She's owed the interest, but she hasn't actually been paid it yet. And then she's going to record the credit to interest revenue. And let's say this 31 March 2010. Okay, so this is so that the right amount of interest revenue gets recorded in the 2010 fiscal year and shows up on the 2010 financial statements. How much is it? Well, let's see. The annual interest was $500, right? But now we're only talking 3 months, January, February, March. So 3 over 12 times the 500 gives us $125. So that is the amount of the entry. Now, fast forward 9 months later, 31 December 2010. This is now a different fiscal year for her, right? So this first interest revenue of $125 showed up in the year ended March 31st, 2010. This will show up in the year ended March 31st, 2011. Okay, so December 31st, 2010, she gets paid cash, right? That would be the full amount, $10,500. That's when the actual cash happens, just like it happens up here, right? And on that date, we have to make the note receivable disappear from our books because it's now been paid, so that goes away. The interest receivable also has to disappear because we've been paid, right? And that leaves now finally the amount to report for interest revenue, which is the interest revenue that's earned over the 9 months over which this loan has been outstanding in this fiscal year, and that should be, my pen is giving me grief here, $375 to make the entry balance. Now, what happens if Brenda doesn't collect the note on December 31st? What happens if it expires? Well, in that event, the note no longer is worth anything. That piece of paper has been, basically repudiated. They say we're not going to pay, or we can't pay, or whatever. Then what happens is, if can't pay, then on the 31st of December, if they don't pay, what happens is we reestablish a liability in the form of an account receivable for $10,500 because we don't have the note anymore. It's the contract has kind of been violated. Now you can still sue based on the fact that you had an agreement and they didn't pay and so on, but you end up with an account receivable, and the note receivable, because it no longer exists, it's no longer in effect, it comes off your books with a credit, and then you get the interest receivable of $500. Now, I should say this goes back to assuming the earlier example where it's all in the 1 year, right? The journal entry would look slightly differently if it was this example up here with the 31 March year end. At the end of the day, though, you'd end up with account receivable of $10,500, and you wouldn't show interest receivable or anything else. And we will carry on this lecture in part 2.